I love difficult equity markets. To me, a bear market is a sale. And what I'm seeing is that companies that I have wanted to buy for substantial periods of time, or at least stocks I've wanted to buy for substantial periods of time, but I've been unable to buy as a consequence of low prices, have corrected. So for me, as usual, the worst of times becomes the best of times. I'm attempting to place capital. I note that the last time we visited, we spent a substantial time talking about uranium. And I said that we would pass into uranium bull market when the pace of Japanese restarts accelerated. That happened, and we're in a uranium bull market. Uranium is outperforming other commodities. I would use this not so much as an I told you so, but rather to reacquaint your audience with the fact that commodities that are out of favor are the commodities that you buy. One really, truly hated commodity right now, one that's disappointed investors for at least 3 years, is silver. So I'm starting to look for silver stocks. I like them when nobody else loves them. That isn't to say that you exit the uranium stocks yet. I think that uranium has at least a year to go in a bull market. If you're there, be right, sit tight. If you're not there, if you're coming into the space, you need to exercise some caution now. It's not a no-brainer, like it was the last time you and I talked. As to the broader question around commodities, I continue to be attracted to precious metals. I'm attracted both to precious metals and to precious metals equities, although some patience will be required. I'm attracted, too, to industrial materials, although I suspect that the next year will be challenging in the industrial materials market. I don't think a Chinese rebound has happened anywhere near as quickly as people would have preferred. I believe longer term, however, that the market for industrial materials will return and will return in spades. I think that's true because I think we've underinvested in productive capacity for a very long time. And as world population growth continues, and as the material ascent of humankind continues, that the ability to produce that we currently have around several materials will be insufficient to meet current, let alone future demand. I continue too, Jesse, as I was in our last interview, to be particularly bullish around fossil fuels, oil, gas, coal, things like that. The big thinkers in the world, the Justin Trudeaus, the Joe Bidens, my favorite energy physicist, Greta Thunberg, people like that to tell you that the era of fossil fuels is over. I would note, Jesse, for your listeners, that humankind has now spent almost $5 trillion US in 40 years on alternative energies, and we've reduced the market share of fossil fuels from a high of 82% all the way down to 81%. $5 trillion has reduced fossil fuels market share by 1%. What does that mean? Oil and gas, stronger for longer. Coal, stronger for longer. Uranium, stronger for longer. Note, I'm not against alternative energies. I want to put them in their place. I'll add them to my portfolio when they're economic. I like things that are absolutely cheap. I like things that are relatively cheap. And the way you get them is to buy asset classes that are out of favor, particularly with impatient competitors. I'm attracted to electrification, not because Mr. Biden likes it or not because Mr. Trudeau likes it, but rather because 1 billion people on Earth currently have no access to electricity. And I think in the next 20 years, all of those billion people are going to have access to primary electricity, which means that the demand for all of the economies, all of the materials around the electric economies are going to increase. I don't think this is as much about electric vehicles as it is about the urbanization of people in India and Malawi and Indonesia. And I think that's all a good thing. I think distributed storage, which is to say the ability of people to generate electricity and store and use electricity independent of centralized grids, is an important theme too. And in order to do this, we are obviously going to have to access battery technology. Some investors should construct their entire portfolio out of royalty and streaming companies. Royalties are an interest in a mineral deposit, an economic interest in a mineral deposit, where you get a piece of the production off the top. You aren't responsible for capital expenditures. You aren't responsible for operating expenditures. So after G&A, your gross is your net, which is a very nice thing. Not being exposed, rather getting a check without getting a bill, in effect, is a very nice thing. A stream is different. A stream is an economic interest in the output or throughput of a deposit. You pre-buy the right to receive a product stream at a fixed price for a fixed period of time. But again, you have no capital obligations, you have no operating cost obligations. Your obligation is the contractual price that you have agreed to pay for the material. These are durable, high margin, very predictable, very valuable businesses. And an argument can be made, if you're willing to give up some of your upside in a raging bull market, that the fact that you have very little operational downside makes these extraordinarily attractive investments. They're much easier to construct net present values for because you don't have to take into account cost inflation, as an example. You don't have to take into account wage settlements. You don't have to take into account sustaining capital investments or new project investments. These are purely an economic interest, either in the deposit itself or in the product stream for the deposit, which means that you construct a matrix of commodity prices that you expect in the future. I use the forward strip as an example, and then I use a discount to the forward strip, and I use a premium to the forward strip so that I can construct a matrix of price expectations. And then I construct models around the expected output of the mine in question and attempt to arrive at a rough net present value. If the company is selling at a reasonable discount to what I think it's worth, I have a buy. If, by contrast, the company, as it often happens, is selling at a large premium to the net present value of those free cash flows, I sell. The second thing that you look at is investment acumen, or what in the oil and gas business is called the recycle ratio, which is to say you quantify the track record of the management team at redeploying the capital that they get from the payments that they receive from the mining companies into new investments. In other words, is the company growing, or is it at least maintaining its revenue base? So you look at net present value, and then you look at what I call recycle ratio to give you some sense of what the asset is worth and what the probability is of the growth of that asset in the future. I've personally moved on from lithium because I believe that markets work. The fact that lithium prices have quadrupled in 5 or 6 years brings a market response. And we're seeing a market response. We never had a shortage of elemental lithium. What we had was a bottleneck in capacity for lithium chemicals because lithium demand increased so quickly that the fabrication of the final products became a problem. We're seeing a circumstance now where we are debottlenecking existing supplies at the same time that we're increasing new supplies. And if, and I say if, not necessarily when, the oil and gas industry perfects the technology around extracting lithium from co-produced saltwater brines in oil and gas extraction, then the lithium business is swamped. Notice that I said if, not when.